Craig's going to provide an overview of some of how COVID-19's impacted the Western Sydney economy and some detail on some of the macro factors influencing business and consumer confidence, as well as some insights into the industries that have been most affected and the areas that can help accelerate our bounce back. For those who don't know Craig, you may have seen him on TV or in the media. He's a fairly regular economic commentator. He established a pretty strong reputation for being able to translate some of the big picture financial trends in a practical and meaningful way for consumers and customers. So we'll be joined by myself and my colleague Luke Turner, our Director of Policy, along with Theo, partner at Deloitte. He's also the Dialogue Special Economic Advisor. Following Craig's presentation, Theo, Luke and I are going to throw a few questions at Craig off the back of the presentation, and then we'll throw it open to the floor for Q&A. So without further ado, I might hand over to Craig to kick things off. And he's got a 15-minute presentation to get through, and then we'll have a chat afterwards. All yours, Craig.
Well, thank you very much, Adam. It's good to be with you all here today, and certainly, hopefully, by the end of this session, we'll be all taking away some, a little bit of insights in terms of how the big picture economy is travelling, and more importantly, as to how Western Sydney is travelling now. My computer sometimes, it does chuck wobbly, so let's see whether how good it is in terms of displaying my slides. How's that?
That's great.
Done. Perfect.
All right. Okay. Yes, unfortunately, COVID continues to dominate the situation. So it is on the front page, and it's littered, with references all the way through. But we have shifted, somewhat to from zero COVID cases, or that being a goal by state, territory, and federal governments. To living with COVID, and will certainly will be one of the major themes for the next year. Just how we go about that. Now, before I go too much further, I've got to put up the most important slide for my presentation, which is the disclaimer slide. So anyone from a legal background or compliance background, this is your slide. I haven't whipped around the Teams meeting today. I don't know your own personal circumstances, so this is very much of a general nature. Now, by normal convention, I will stick to very much a macro picture. Drill down, where it's possible, but I am a macroeconomist and providing views at a macro level. But what we'll start with a big picture in terms of the more broader Australian economy, drill down in terms of the state, and then get down to Western Sydney, and you'll see certainly the SA4 level representation of Greater Sydney being represented through this presentation today. If you go back a few years ago, the advice for anyone wanting to sound as an expert on the economy was just to answer China to all economic questions, and you couldn't go too wrong. Now, if you want to be seen on an expert, you have to answer COVID-19 to any economic questions, because really, so that's at the heart, not just of what's happening in Australia, but of course, we're right the way across the globe. We've gone through some evolution over time. Certainly, COVID hit us, and we did the same thing as every other economy did. We went into lockdown to try and prevent our health system being overstressed. So we did have some early success in terms of suppressing the virus, and I suppose the early part of this year was looking good, across Sydney. It looked as though we'd beaten the virus and we were moving forward. Then, of course, came the Delta variant, and the strategy shifted yet again. Now, of course, the importance of vaccination, and indeed, it has been quite remarkable just how New South Wales in particular, and Australia more broadly, has embraced vaccination. Now, we're still not out of the woods yet. We've still got some challenges to come, and I think so what we are going to see is a bumpy period of adjustment as we come out of lockdown and we get down to a degree of what we will now call normality. But the stimulus has to continue for some time. That's what the Reserve Bank has been telling us. That's what the federal government's been telling us. They'll start weaning us off the stimulus over time. But if we're thinking about one of the major challenges for our economy, it's getting the timing right of withdrawing from the stimulus. And indeed, we're seeing that challenge is very much being played out across the globe. We've got some central banks which have already started lifting interest rates. Overnight, we had one of the highest inflation rates in the United States, or highest inflation readings that we've seen in 31 years. And that's raising some degree of concern about what happens next in the United States. Do they have to become more aggressive in terms of inflation? So inflation, jobs, economic growth, they're going to be key issues, sort of going forward. We just need to get that timing right to make sure that we don't take away the stimulus too quickly, and make sure that we're in full recovery mode before we go further. You can see one of the first tables that I provided is the population figures of Greater Sydney, just to put it in perspective how each of the SA4 regions are looking in terms of population. Clearly, in terms of the last 12 months, little or no growth right the way across the Australia in terms of population growth. But heading into the crisis, Parramatta was seeing some of the strongest growth rates, decade average growth of 2.4% in terms of population. The southwest 2.1%, and Blacktown was recording 2.3%. So when we think that was having a population growth around about 1.5%, 1.6 at its max, certainly we were seeing some pretty strong growth over the last decade. And that's provided a greater housing options, and it's provided a greater jobs for people as well. Certainly, what one of the major features has been over the last 12 months is the strength in terms of the housing sector. And you can see, so I mentioned building boom as one of the key factors in terms of going forward. That will be very much the case, and it is very much the case in terms of construction at the moment. But with super low interest rates and the job market in pretty good shape, what we're seeing is strong demand for housing, and we need supply. We need those homes to be built to prevent housing affordability becoming a significant problem. One of the major trends, as all of you probably know, is when COVID hit, people had a reassessment in terms of their housing needs. A lot of people decided, look, in a 2-bedroom apartment, so there's not enough room for me to operate. I have to look for a house rather than an apartment. Those people in houses look to redesign their homes, or look to move, or either build extensions to accompany things like home offices. So it's quite remarkable over the last 12 months. House prices in Sydney have grown at a 30.4% annual rate. Apartments have only grown at a 13.6% annual rate. That shows the degree of supply, I suppose, in terms of apartments, more plentiful in terms of supply, but also the demand element as well. Strong demand for freestanding houses and homes with more space in them, whether it's apartments or whether it's freestanding houses. In terms of Greater Sydney, house prices up 25.2% over the last 12 months. In terms of the broader Australian economy, well, certainly the September quarter last past, we're going to see a big fall in terms of output. So our expectation of the Commonwealth Bank Group is a 4.3% fall in terms of economic output before rebounding in the December quarter. So the good news is that New South Wales is coming out of lockdown, and the mobility continues to improve. We're seeing that in Victoria. We're seeing that in ACT as well, and we're hoping to see that more and more across the rest of the nation as well. So that will be very much reflected in the December quarter economic growth figures, and also the March quarter. So we hope that we're finally on the recovery path from here, but we can't clearly be completely sure about that, as we know, so what we've experienced in terms of Delta over time. Now, A lot of people are asking, so when are interest rates going to start rising? That's the $64 question. This is a ready reckoner to be able to focus on. The jobless rate, I didn't see this morning's figures, which was released only sort of 13 minutes ago. I didn't see what those figures were, but the jobless rate was sitting at 4.6%. The goal for the Reserve Bank is to get it down to 4%. So there's still a little bit of way to go on that. Inflation sitting at 2.1%, and the Reserve Bank wants inflation sustainably between 2 and 3%. Wage growth, we'll have some figures on wages next week, currently growing at a 1.7% annual rate. The Reserve Bank wants to see 3. So you can see in pretty simple terms, this is what the Reserve Bank's strategy is to be able to get a higher inflation, a tighter job market, higher wages, and then only then will the Reserve Bank start to lifting interest rates. Now, the Reserve Bank still of the view that it'll be 2023, late 2023 at the earliest before interest rates start rising. Ourselves at the Commonwealth Bank Group, our position is that we could see interest rates rise in 12 months' time. So you can see that we're probably a little bit more aggressive than the Reserve Bank, but what has to be achieved is effectively these goals that are on the screen in front of me. You probably do know that CommSec does a report called State of the States, and the last one that came out was only a couple of weeks ago in late October. And what we saw is New South Wales, I think quite remarkably, in third position on the leaderboard. What we look at 8 indicators and we compare those 8 indicators for each of the states, the latest variable compared with the long-term average, and see which one in relative terms, which state or territory in relative terms is doing better on each of those measures. And New South Wales was doing number 1 in terms of housing finance, number 3 in terms of dwelling starts. So that's where the relative strength for the New South Wales economy was in terms of buying and building homes. And indeed, with more dwellings being started, more homes being built, that's going to provide good momentum for the Australian economy, and particularly for ourselves in Greater Sydney. There's something else that we look to also in terms of the state of the states. We look at economic growth, annual growth in terms of the indicators like retail spending, employment growth. We look at annual growth figures to be able to give us an idea of momentum, and on 6 of the 8 indicators, New South Wales was leading the Australian average. So that shows that not only was New South Wales number 3, it had some good momentum on its side. So I think given the amount of support that the New South Wales government's been applying, the strength that we're seeing in terms of the housing sector does augur well in terms of the future. And of course, that's just covering the housing sector. As we know, travelling across Sydney, there's a significant amount of activity in terms of broader infrastructure. This table basically shows the relative position of the job markets across Greater Sydney. I think one of the things that stands out, one of the areas of challenge for Western Sydney going forward, is the fact that in relative terms, the unemployment rates are still somewhat on the higher side. You can see that in terms of the southwest, where the average annual unemployment rate up to the year to September was 8.8%, 7.4% in terms of Parramatta. And you compare that with regions like Sutherland, 2.9%, Northern Beaches, 3.2%. That's the real challenge. The real challenge for Western Sydney is to get that unemployment rate down and getting to approaching areas like the eastern suburbs, North Sydney and the Hornsby, Sutherland, and also Ryde to some extent, as well. The next table represents home prices, and indeed, one thing I should say in terms of these slides today, if anybody wants a copy of the slides, I have no problem in the presentation being distributed around the group and more broadly across the your organisations as well. The disclaimer slide's in there, so no real problems in terms of disseminating in terms of the data, but this gives you another bit of a picture in terms of how home prices have been travelling up until late. And I suppose the encouraging thing in terms of home prices is the strength that we're seeing right the way across the board. It doesn't mean to say that if you've got a high level of unemployment that it's affecting the degree of home price growth. As we do know in terms of housing, it's supply and demand which determine price, and demand is strong at the moment because the job markets have been quite encouraging, relatively low in terms of unemployment and job opportunities, and indeed job vacancies are soaring at the moment given the borders are closed. The degree of purchase assistance that's been provided as well. So demand is strong at the moment, and supply is the one that will be catching up over the next 12 months, and we will expect to see home price growth slow over the next 12 months as more supply comes on board. In terms of home building, in terms of that supply, again, it gives you a bit of a perspective about where the growth is. And I will highlight the Baulkham Hills Hawkesbury area. It's one of the main building areas across Greater Sydney, over 4,000 on an annual basis, up 83.6% over the last 12 months. So shows you the degree of growth that's happening out there. And we're seeing that in most of the places, except for perhaps if we look at the inner west and the northern Sydney and Hornsby, as well as the outer west and Blue Mountains. They're not seeing the same degree of home building as we're seeing elsewhere, but most of the regions across Western Sydney, we're seeing some strong levels of home building, and indeed that's fueling economic activity quite nicely. These are some of the themes that we can think about and digest perhaps in the discussion going forward. Sustainability is a key important factor for any business nowadays, and it's got to be one of the hallmarks in terms of working out strategy for business. The need to be agile has really been demonstrated over the last 12 months. Those businesses that have got good supply chains, diversified supply chains, a good online presence, they've been the ones that have done very, very well over the last 12 months. And indeed, having that online presence, having that good supply chain is going to be all important going forward, because you want to be able to get access to the goods that your customers need. What you're going to need is those prices not to be going through the roof, and you would need to be able to deliver those goods to either the boot or the doorstep of that individual household. Some of the other features that I mentioned on this sheet, things like new attitudes to travel. I think we're all now become very, very much experts in terms of things like Zoom meetings and Skypes and Teams meetings. And I think we're going to see more and more of that. So we're going to probably see less travel and more engagement through this sort of mechanism. And I think the other thing is that businesses have worked out, and it's not about the number of workers or where those workers are. It's about tasks being completed, which is the new norm going forward, rather than how many workers that you've got employed to be able to do the work. Consumer themes. Certainly we have seen a demand for freestanding houses rather than apartments. Going forward to travel, it's going to be one of the big challenges for some of the key tourism areas around Australia, whether they will continue to be able to attract domestic tourists, or whether people, particularly younger people, may be zipping overseas and doing that in preference to taking their holidays domestically. So there's tremendous opportunities, but there's tremendous challenges for businesses as well, as people come out of lockdown and exert their preferences about what they want to be doing, particularly in terms of travel. Again, I say that we can just discuss some of these themes going forward. And finishing up the document is just a little bit of data on some of the, notably it's from the Deloitte Access Economics Register of Investment Monitor, just highlighting some of the key projects going forward and some of the things to look forward to, particularly if those infrastructure or construction projects that are under consideration go through to the committed and get underway. Yep, we are on the exit path, and government support is going to be super important, and rates are still going to stay low. The question mark is how long the interest rates will stay at these super low levels. Will it be 12 months' time, like Commonwealth Bank is expecting, or is it going to be a little bit longer, as the Reserve Bank is expecting? And indeed, we've had some major themes in COVID, like the way that people have worked from home, embraced online shopping, gone down to the local cafe rather than gone into CBD areas and engaged that way. How is that going to change going forward? And the final slide that I've got today is the typical way an economist generally ends up the presentation. These are the forecasts. In simple terms, what we're saying is focus on the calendar years 21 and 22. You can see that over 2022, we're expecting 4.4% growth in the Australian economy. Normal growth in Australia is somewhere around about 2 or 2.5%. So 4.4% is something to look forward to over the next 12 months. In fact, the Reserve Bank is saying that it could be closer to 5% over the next calendar year. So we are looking for strong growth ahead. That raises questions about just how quickly we will get to the targets of inflation, unemployment in terms of wages, and gets down to the fact of how quickly the Reserve Bank will be thinking about lifting interest rates. So I might leave that there.
I want to circle back to your earlier point, Craig, where you started into looking at COVID at the start of it last year. And obviously the threat of a recession was widely touted, and it probably had more sort of impact in Western Sydney than other parts of the city and Australia. But it didn't really eventuate. Come full circle back to this year, and the threat was even more ominous, the situation more ominous. Based on those figures, the outlook seems a little bit more optimistic than first thought, and maybe the Western Sydney economy is potentially a little bit more robust. So I'm interested to get your point on where we're at in terms of, are we in a recession? Are we approaching a recession? And how exposed is Western Sydney when it comes to sort of that economic trajectory? And maybe Theo might have a view on this as well.
We've got to remember that the support remains from federal, state, territory governments, from the Reserve Bank. So we still have a situation where the official cash rate is at 0.1%. So I sometimes have to wipe my eyes and just work out whether I'm actually saying it right or writing it right. That so where the cash rate is 0.1%, it's just quite remarkable. Effectively, so it's at zero. Now the Reserve Bank is saying we're going to keep interest rates at those levels until 2024. It backtracked a little bit, so when it last handed down its forecast, said, look, if everything turns out brilliantly, it could be 2023 before we start lifting interest rates. But the Reserve Bank's saying we're in no rush to start lifting interest rates. And indeed, they're still buying bonds. They're still buying bonds in exchange for cash and putting that cash to work in so the systems. We've still got a degree of support being provided by federal governments and state governments. We've got the vouchers, which were expanded by the New South Wales government. That's been providing extra dollars for people to go to cafes, restaurants, entertainment venues, and the like. So that's sort of quite encouraging. But it is one of the things that we've got to watch very, very carefully. If the rug was pulled from under us in terms of support, so then there would be some dire circumstances going forward. But as we're sitting at the moment, there's a lot of homes that are under construction, and that's providing sort of jobs for people. I suppose it is quite perverse when you think about it, sort of 12 months ago, and as you say, so Adam, when we think about it at the start of this year, you think about, sort of we're headed for significantly, sort of bad times, but we're coming out of COVID, and the greatest complaint by businesses is they can't find the staff that they need to do the jobs. And it's just highlighting the fact of a disconnect between those people who either have the skills or want to do the jobs. They just seem to be in short supply, particularly in hospitality, particularly in areas of construction as well. There may be some skill differences, but people have got to want to do the jobs as well as have the skills to do the job. I think for a lot of younger people, so that are looking for jobs, if they don't embrace the opportunities before those borders fully open up, then they're going to miss out on tremendous opportunities to be able to get, sort of good job, sort of a good firm, and you'll be able to work, sort of in a sustainable, sort of way. So it is quite encouraging, I think, in terms of the outlook. There's some challenges there as well. You think about the lockdowns in terms of particularly CBD areas. It may be Parramatta CBD as well as Sydney CBD. They've been doing it tough because people have been working from home. So people have been working from home, and they might be sort of out in Bankstown. So they might be out in sort of Penrith. So where are they getting their cafes? Where are they getting their coffees? They're not sort of work in the CBDs, sort of, and frequenting sort of the coffee shops there. They're going local. They're going to local cafes and restaurants. They're buying sort of locally, and certainly there's a lot of suburbs across Australia that have actually benefited from the fact that people have been working from home rather than working in cities. So what changes, so going forward, if the CBDs start opening up again, they may lose some of that business. So there's a challenge there for a range of businesses to be able to hold on to staff or to engage even more with their customers to make sure that they're benefiting from the opening up of the economy. I can tell you in terms of this building that I'm in, on this floor that I am in near Darling Harbour, 1 Harbour Street in Sydney, there's usually around about 100, 150 sort of people on the floor. There's probably 10 people on the floor at the moment. And I'm told that's not going to change too much out to February of next year. So it's quite an interesting situation that some big corporates like the Commonwealth Bank are taking.
Thanks for that. I want to, excuse me, throw to the point you made around skills. I know Theo's consistently outlined this as an issue around skills shortages in Western Sydney, particularly given the sort of handbrake effect that immigration's had. Theo, picking up on that skills point, and then I want to throw to Richard and Caroline. I can see their hands up. What's your take on it?
Like, I think it's really interesting when you look at what Craig's just presented, and great presentation, Craig, and being able to start to look at the relative unemployment rate across areas of Western Sydney, particularly Southwest Sydney. And what it brings out to me is that there are structural differences that exist out there. The nature of the work, there's greater part-time and casual work than there is full-time work. The nature of the roles that people are doing are less value-adding in certain instances as a greater proportion. So I think that for me, that continued investment in skills development, many of those opportunities that Craig talks to, people are out of reach of people at the moment because they don't have the skills. And so I think that investment and continual capacity building is going to be super important, particularly across Western Sydney, and that we're starting to see many of those traditional industries pivot. I hate using that word, but they're pivoting away. They're more digital. There's other aspects that are coming into play. And so there's a greater sectoral transition that's happening, and the emergence of new industries, particularly around Bradfield and the investments that the government and private sector are doing there. So I don't think that Western Sydney can be complacent that it can ride along on the coattails of what I think Australia's economic success will be. That if it doesn't raise that capacity and if we don't start getting further investment in skills, I think that what you'll find is that the opportunity that comes out of Western Sydney will be taken by people outside of Western Sydney. And I think that's the greatest risk in the region.
I'll throw to Richard, and you're right, Theo. I think pivot along with you're on mute, probably the two most common terms we've heard over the past 12 months. Richard, you had a question.
Craig, could you just give us the drivers for your views on the Aussie dollar for the next 12 months and beyond? Because I'm assuming at 72 cents, you're seeing weakness in our export revenues, which makes me wonder about inbound education, export revenues, tourism and the like. 72 cents is quite low. What are you thinking?
More in terms of interest rate differentials rather than anything else. What we saw overnight is the Australian dollar lost around about half a cent and around about down from 74 cents down to below 73.5 cents now. So and a key factor for that was the fact that US had inflation figures which were well above expectations. The fastest rate of consumer price inflation that we've seen in 31 years. So that's raising concerns that the inflationary pressures are not temporary, not transitory. They could become a little bit more permanent, that the US economy is perhaps travelling a little bit too well and doesn't need the stimulus in place. So it's raising questions about how aggressive the US Federal Reserve is going to become. We have been looking for levels like 72 cents. If you look at those forecasts, so moving forward, so what we get down to further out is 75 cents by June of next year, 77 cents in September, and 80 cents in December. What happens, in our view, in late 2022, is that the Reserve Bank gets into a closer position here in Australia for increasing interest rates, and that's where you'll see the Aussie dollar lift a little bit. So think about relative interest rates as being a key driver. Of course, demand for commodities and commodity prices is another important influence there. But if anything, what we're seeing is a significant degree of strength in terms of our export situation. The rest of the world wants our iron ore, they want our coal, they want our wheat, they want our beef. So we're seeing some really good strength in terms of exports, not just in terms of non-rural goods like iron ore and coal, but in terms of rural produce as well. And conditions out in regional Australia are quite remarkable at the moment. Usually in the past it's been either droughts or bushfires or floods, but if anything at the moment, we're travelling okay, and prices for our commodities are okay as well.
Thanks for that, Craig. Caroline, you've been waiting patiently down there. All yours.
Thanks, Adam. Hi, Craig. A question just around Sydney's competitiveness in a post-COVID world. So particularly around kind of attracting talent and foreign investment. What trends do you expect in a post-COVID context, and how do you see that this might be different to pre-COVID?
Well, certainly there are challenges for every economy with the opening up. You can think of it, over the last 12 months that regional and rural areas in Australia have benefited from the fact that the borders have been shut. So people, if they wanted to go anywhere, provided they haven't been in lockdown, of course, have had to travel, domestically. So we've had, in terms of capital cities have been, hard hit, whereas suburbs and regions and rural areas have done, very, very well. The key challenge will be, now in terms of the opening up and what that means, whether we see a change in terms of that, whether we see areas like the rural and regional areas failing to benefit because people are travelling overseas instead. Are they going back into CBD areas? So there's a lot of question marks, and I don't think a lot of those have been resolved as yet. For Sydney, compared with other capital cities in New South Wales, compared with other states, one of the issues will be in terms of affordability, particularly in terms of housing affordability. So some of the strongest growth that we've seen into home prices has been in Sydney. Now, our hope is that what we are going to see is the building coming through, the supply coming onto the market. Some of the pent-up demand being met, and that over 2022 we're going to see much slower growth in home prices, around about 5 to 7%, rather than 20-odd% that we're seeing at the moment. So, but that will be one of the challenges going forward. People who are coming from other states or territories will be looking at Sydney and saying, well, how am I going to get my quality of life? How am I going to work sustainably, in a place where I'm paying out so much in terms of a mortgage? Same in terms of migrants coming from overseas. They might see great opportunities in Sydney, but so that may lose out if they look to other areas of Australia, whether it's regional New South Wales or whether it's other states or the territories. So that is one of the challenges going forward. Infrastructure is one of the areas that we're seeing a substantial improvement in Sydney over time, and I think it's going to continue to improve given the amount of construction work underway. So infrastructure is going to be one of the shining lights, I think, in terms of people's desire to live in Sydney. We're going to be able to get around a whole lot easier than what we did in the past. There's still some challenges there, but certainly substantial improvements have been made, and I think are going to continue to be made. Housing, though, is one where we've really got to focus. That could be sort of prove a real challenge in terms of attracting and retaining people in the Greater Sydney area.
Thanks, Craig. I've got Bonnie and Richard, but before I throw to Bonnie, I want to just follow up on Caroline's question, particularly around international investment and looking back towards last year, where one of the competitive advantage that Sydney had and Australia had was its sort of management of COVID, that it was a safe place, that things were relatively under control. Obviously, things have shifted a fair bit in 12 months since. Ben, I recognise this might sort of sit outside your sort of economic scope at CBA, so maybe it's just a personal view. But do you still think that there's a opportunity to leverage our health systems and how we operate as a way of attracting international investment? Things like, for instance, I know there was a big push around film studios and getting things produced here because the states weren't. Now that sort of things have opened up a bit and things are almost operating normally, that seems to have subsided, and that advantage that we had 12 months ago is no longer there. Is that how you'd see it as well? And Theo, you might have a view as well.
I think there's a nice balance, which is happening in terms of New South Wales. Of course, we're so 90% double vaxxed. If you put Australia against countries around the world, we'd probably be in the top 3 or 4. Sort of United Arab Emirates is right at the top. Portugal is at the top, as well. They're around about 89, to 90%. So New South Wales has done very, very well in terms of getting the vaccination rates up, keeping the caseload, sort of relatively low, around about 200 cases, so we're averaging at the moment. But able now to open up the economy. Compare that with Western Australia, which is taking a different sort of approach. Same in terms of Queensland, so same in terms of New Zealand as well. So these things have fluctuated, a little bit over time. But I think the strategy that's been developed by the government and by the health authorities here in New South Wales does augur well for our standing as an economy and our ability to be able to do business and do business safely. And hold events safely, here in Sydney now. Clearly, so things could change over time, but I think so we've done sort of well as a state to get to the position we are today. Indeed.
Bonnie, what are yours?
Yeah, thanks, Adam, and thanks, Craig, for a really fantastic presentation. I just start with I looked at the unemployment rate when it came out. It's jumped quite sharply to 5.2%. So I'd be really interested to unpack the data that you had on the SA4s to see how much of that is kind of driven by the harsher lockdowns and the LGAs of concern. But that's not my main question. My main question is around the state of the state. So I think that those reports are fantastic. And I noticed that obviously New South Wales has got that infrastructure play. I guess my question is around, is there anything that's kind of unique to Western Sydney? Like what's the key things that are going to drive growth in Western Sydney over the next, 3 to 5 years? Like you've talked a little bit about infrastructure, and we know around Bradfield and the second airport, a lot of construction. But is there anything else that that's kind of worth thinking about in terms of Western Sydney specifically?
Well, I think you look at Western Sydney and make comparisons with other parts, whether it's Southern Shire, Eastern Suburbs, Northern Beaches, Hornsby areas. In terms of home prices, is certainly more favourable than some of these other parts of Sydney, as I mentioned. I think home building sort of continues to occur, and that's providing sort of growth. Population demands, I think sort of we're going to see population sort of rising again. So there's things like improvement in infrastructure over time, the amount of opportunities. So it does get down to the amount of opportunities, and if the opportunities continue to rise, then Western Sydney sort of benefits. And I can see so that is happening. But population, they say, is power, provided it is planned for sort of appropriately, and with population likely to continue rising at a fast rate in Western Sydney, that's going to create the demand for retail, for services, so the like, and it will create the demands on infrastructure. And as long as the government maintains its focus on providing so the right infrastructure for the right areas, then there's great opportunities for Western Sydney.
Craig, how does Western Sydney sort of wean itself off I suppose, addiction to population growth and infrastructure investment as its main economic drivers? I know that Theo's raised this point earlier as well about how do we start looking at industry growth, development of smart jobs, and skills obviously part of that, but it can't, I think, sustainably continue as reliant solely on population and infrastructure investment as its two main sort of drivers of growth, right?
Well, certainly that is the case. I mean, sort of things like working smarter, so not harder, sort of if you have productivity, sort of improvements, that can provide the degree of growth. But you think, sort of how do certain economies sort of do well? You think about the Western Australian economy, what does it rely on, and so what drives growth? And it's things like iron ore, it's things like the mining sector. You look at your relative advantage, and the relative advantage in terms of Western Sydney is the access to people. As long as you improve the infrastructure, the ability to be able to get around, and the cost of living, sort of provided, so you can keep that constraint compared with other parts, so they're doing, so better as well. So I think that's one for also areas of government to be able to do a little bit more work on, sort of as well. The location, we're trying to talk about, sort of smarter way of addressing things like climate change going forward, and the sort of new businesses that will be required, and making sure that you can get tap into some of the money the Clean Energy Finance Corporation is going to be shelling out in coming years to address the climate change debate, wanting some of those facilities to be located in Western Sydney rather than sort of other parts of New South Wales or other parts of Australia.
Indeed. Naomi Hastings, one of our lovely Gen Westers.
Thank you, Adam, and thank you, Craig. Craig, I apologise. Halfway through your presentation, I got a call from my employment agency. Funny, we're talking about unemployment. So I've been on job seeker payments since the start of COVID last year. And I've gotten quite comfortable on these payments. And my appointment was actually supposed to be on earlier this morning, but my provider is so flat out with clients at the moment, because unemployment's so high at the moment. Anyway, my question is around complacency in unemployment. The concept of UBI, so universal basic income, was thrown around quite a bit last year, and I'm wondering if you have any comments on that concept. Because I imagine at some point there are so many jobs around. I won't have an excuse to not have a job right now, but at least once I saw so many of my peers become unemployed, becoming on the dole kind of lost a lot of its stigma in the past 18 months, I feel. And I'm wondering, what do you think the implications for that are?
Yeah, that is a real challenge for government. That's why you can, sort of the Treasurer has been very much focused on that we couldn't keep JobKeeper in place forever. We couldn't keep Job Seeker in place forever, because the longer that people, sort of sitting at home and the dollars, sort of coming through, they're saying, well, this isn't such a bad life. Sort of the dollars are coming through. It may not be, sort of the first style of income, sort of that I want, but it's enough for me to be able to do what I need to do. So you need to be able to pare that back over time. I've got a daughter, so that's employed, sort of as a swim instructor as well. She's had, some difficulties over time because of the closure of indoor pools, but now she's back and working again. She's had the same sort of thing where she was on JobKeeper and Seeker, so those payments are scaling down over time. fortunately, so the workplaces are opening up and she's getting so the jobs, but and now it's a case of choosing so the jobs which are available. So it does show that the reopening of the economy shows how much change is happening at the moment. The people have been sitting on the sidelines for so long. Now they're getting back into the job market. Some people that have been employed with an employer for quite some time, they're thinking about, do I actually stay there or do I move around the place? And of course, you've got to be relatively confident in terms of your own financial situation and the outlook for the job that you do. To be able to say, well, no, I'm going to ditch this and I'm going to move somewhere else. So we're talking about the Great Resignation. That's one of the themes that are happening, not just here in Australia, but happening in other parts of the globe. The people have been thinking for some time. They've had a degree of time to think. They just say, no, I don't want to be a lawyer anymore. I want to be a chef. As we see so many MasterChef contestants seemingly coming from law for some reason, or for accountancy, so they all want to become chef. And we've got a shortage of chefs at the moment, so perhaps we need to be seeing some more people thinking about that same sort of way. The other interesting thing is the borders have been closed, and with the borders closed, the positions still need to be filled. But so we've got Australians who either haven't got the skills or don't want to do the jobs which are on offer, and that's something that will need to change and will change in coming months. You mentioned in terms of the jobless rate, sort of lifting in the latest month. These things do bump around the place, and I think so what we've seen is probably the worst of the figures so today. Once we get the November and the December data so coming through, I think we're going to see a substantial improvement. We do know in terms of job vacancies, the National Skills Commission came out with a report this week showing the number of job vacancies across Australia at the moment is the highest level in 13 years. And that's existing basically all the states and territories are seeing similar sorts of magnitudes. There's plenty of jobs on offer, and with the borders still relatively closed, so it's providing a degree of opportunity for people to pick around and see what they want to where they want to work.
You're on mute, Adam.
Oh, thanks, mate. Thanks for that, Craig. It looks like Richard's tech hasn't resolved, but he has posted his question in the chat, which I'll read out now for you, Craig. Hopefully I can do it justice. Now this is Richard's post. In the post-GFC period, I started to hear suggestions about 4 to 5 years ago that markets had topped out and that asset prices would flatten or even fall if we reached the end of the cycle or something else tipped us over. That hasn't happened, even notwithstanding COVID. Is this potentially because we're at the beginning of the next industrial revolution as a result of technology acting as an enabler? Thoughts and potential impacts for Western Sydney?
Well, when we're thinking about asset prices, let's think of home prices and share prices. The share market works on the principle that provided so the companies are doing well, provided the economy is doing well, the companies are making money, revenues flowing through, profits are rising, that should be reflected in terms of the share market. Now, when you have one of the greatest handouts by government that we've ever seen, and we've got super low interest rates, that's provided a supportive factor for businesses over the last 12 to 18 months. The fact that people have been supported in terms of being able to spend through things like JobKeeper and JobSeeker, the fact that they've been able to hold on to jobs in their hibernation period has been important for companies as well. So people have just changed the way that they shopped, buying goods online rather than buying goods in the store. So companies have done well over the last 12 months. Profits have been rising, and that's why the share market's reflecting that. Also, when you've got zero interest rates, you're looking for the best return on your funds. And if you've got share market providing the total returns of 7, 8 or 9%, well, it's a no-brainer. You put your money in the share market rather than you put your money in the bank and get next to no interest rates. Same in terms of the housing market. Housing market really works with things like interest rates as well as the job market. So the two key drivers in terms of housing. But what we're seeing at the moment is super low interest rates, people confident about their jobs or still in work, that provides them with encouragement to go out there and buy homes. And even when you think about investors, they're looking at housing markets and saying, well, I can still get 3-4% of my money in terms of rent. Clearly, sort of investors as well as owner-occupied still be enamoured to go into the housing market. So it's a function of the times. But as I say, there will be some challenges ahead. Interest rates are not going to stay zero forever. And the hard part is, the easy part was just doling out the dollars and pushing interest rates down to zero. So anyone could do that. The hard part is working out the time now to be able to withdraw that stimulus, and that's going to be the hard part for central banks as well as for governments, getting that timing right to make sure that you don't cause some of those asset markets to crash.
Thanks, Craig. Theo, we've got a few minutes left, so over to you, mate.
Yeah, Craig, you were talking about the very generous levels of support that the government have provided over the last couple of years in various formats. And we've seen the infrastructure investment that, and particularly across Western Sydney, that Adam alluded to. But we've also seen, local governments, revenue base crippled, through rates and families struggling. And that, from a Western Sydney perspective, there's still significant social dislocation across the various regions. And so, greater support is needed to be able to make sure we keep people moving forward. Do you have concerns as to the degree to which we can keep dipping into the well and the implications that has, and what you think are the priority areas where spending should be focused in particular to be able to really drive Western Sydney forward?
Well, yeah, I always have concerns, going forward, we're going to have an economy which is doing well at the moment, but there's always going to be challenges. And, as I say, one of the challenges is the fact that we have been, doling out, the money, and, it's got to be paid back over time. That's not a major problem at the moment when you're talking about governments being able to borrow money, and about, the debt interest bill. It's actually, the debt interest bill is very much under control at the moment because of the level of interest rates, and provide the economy continues to revive as we expect, as the Reserve Bank expects. That's the important thing going forward. Where the money is being spent, and is it being spent wisely? I don't know. I suppose that's probably getting a little bit sort of more micro rather than macro, and that may be an issue for others around the room about where they're seeing the government sort of money coming through, where they believe that it should be going forward. So I might sort of deflect a little bit in terms of that, and perhaps leave that up to others to be able to voice their opinions, or their own circumstances, their own experience.
Good answer, Craig. Thank you. I'm conscious of time, and we've got a couple of minutes left, so I might sort of take this opportunity, if there are no other questions, to wrap things up. Craig, firstly, thank you for your effort and insight today. I know you put a fair bit of work into putting something together specific for Western Sydney, combined with your macro knowledge. I think it's really useful, and a great sort of outline of where we've been and where we're going. So certainly appreciate yourself and CBA for partnering with the dialogue today. Special thanks to our economic advisor, Theo from Deloitte, and Luke Turner as well, our policy director, along with Brett and the team, to help pull this in together. Hope that was interesting and you got a bit out of it. As mentioned in the chat, Craig's slides and presentation, he's happy to share. Glad he's put the disclaimer on there so he's covered. And if you need anything further, then feel free to reach out to myself or the team.